Hello, good morning, everyone. Welcome to PhillipCapital Research morning call for 11 a.m. for 10 November today. For today, we have multiple counter updates. We have results coming out from the US market. We have Microsoft, ABNB, AMD, Apple, and Grab. And and for the Singapore market, we have Grab, United Overseas Bank, DBS, Overseas Chinese Banking, First REIT, Stoneweg, and Capital Investment Limited. And then we also have macro sector outlook. For the Singapore, we have weekly, and we also have monthly Singapore update for November 2025. So let's move to the next slide. Also to note that Paul will not be in the session today as he's in the other meeting. Also, Zeng wouldn't be with us today as well because he's on leave because he's joining the Army Reservists. Right. So this is the usual disclaimer. Please be noted that the information that we have solely from the public information, as well as please reach out to your financial advisor before making any investment, right? So for the first presentation, we have Microsoft. So for Microsoft released their first result for 2026 about last week ago, when the focus is on that capital exceed their expectation. So for the first quarter 2026, the revenue and PATMI met our expectation at 24% and 26% of our financial year 2026 forecast. The group revenue grew about 18% and led by Microsoft Azure revenue up 40% year over year. Move on to the first positive point. There's an increase in the Microsoft 365, their production segment, from the enterprise adoption, which is a commercial. So Microsoft group revenue grew 18%, led by the Microsoft 365 commercial, which grows about 17% year over year, which is above the guidance of 14%. So this is quite important because Microsoft 365 products contributed about 31% to the group revenue. And the commercial cloud part section of the productivity accelerated to 17% year over year, which is above the 15% year over year from the same quarter last year. And so this is driven by the increased average revenue per user growth and led by the E5 and Copilot products. Next, we have the Microsoft Azure accelerated again to 40% year over year, right? So these have resulted in the intelligent cloud, which is their cloud services segment, to remain the fastest growing segment with revenue up 28% year over year. So Microsoft Azure and the other cloud services still saw a strong demand across all their workloads. So Microsoft Azure revenue grew 40%, which is above the 33% in the same quarter last year. So this time it is mainly driven by the infrastructure growth coming from their largest customer. And this number of revenue of 40% also exceed their guidance of 37% as the demand continues to outpace supply. Next, on the positive point, we have their commercial RPO backlog surge. So RPO backlog is basically their book order, right? How many enterprises, their customers are booking their supplies in the future. So in the first quarter, RPO rose 51% year over year to US 392 billion. So this was driven by a 112 year over year increase in the commercial bookings. So let's just be informed that many of these RPO is coming from the commercial, meaning the enterprises customer instead of the consumers like retail. So growth with this time was led by Azure, Microsoft Azure commitments from OpenAI and continued expansion in the $100 million contracts for Microsoft Azure and Microsoft 365. But these figures have excluded the additional Microsoft $250 billion of Azure commitments from OpenAI, which was just announced one day prior to the result announcement. So they haven't had yet the time to insert it into the RPO backlog. And then next positive point, we have the operating margin up 229 basis points higher. So this is coming from strong top line, which the revenue grew 18% year over year and coming from the disciplined cost control. And we also seeing that the Microsoft 365, which is a productivity segment, lower cost of revenue growth at 8% has helped cushion Microsoft Azure sharp 43% year-over-year increase. Right. And lastly, for the negative point, we have that overspend on capital expenditure. So for this quarter, their capital expenditure reached 34.9 billion, basically 35 billion. So this is up 74%. So this is above the 30 billions of US dollar guidance that they gave last quarter. So, but about half of these capex was spent on short-lived assets like GPU, CPUs to support the Azure business, and the rest was invested in long-lived asset for their which is to drive monetization for the next 15 years for the cloud and AI services. So it is overspent in the terms that they are spending more than what they give as a guidance, right? Well, if you think about it, that if they having more and more demand, you need to spend money, you need to spend on capital expenditure to generate more money. Doesn't make sense for them not to spend if they have higher demand coming up every quarter. And for the outlook, for the next quarter, Microsoft expect revenue to rise 15% year-over-year. And this is to be led by commercial bookings, the enterprise especially, and are expected to grow strongly. Microsoft Azure, again, is expected to grow 37% year-over-year as demand continue to outpace supply. And an update is that one day prior to the announcement of the earnings call, there was an announcement that OpenAI is going public, and Microsoft and OpenAI has signed a new definitive agreement. So highlight from this agreement is that Microsoft now holds about 27% stake in the OpenAI Group PBC, which is their public listed corporations, which would be listed in the future, which is valued at 135 billion US dollar. So their stakes now decreased from 32.5% before this announcement of OpenAI going public. But Microsoft has benefited. They now receive OpenAI committed on Microsoft Azure. Now OpenAI is going to have about 250 billion of US dollar of Microsoft Azure commitment in the near future. So this would help their RPO backlog in the future. And not to mention that Microsoft IP rights, intellectual property right coming from OpenAI usage of their products now has extended from 2030 to 2032. So that is extended longer. So our view from this is that this is continue to strengthen Microsoft and OpenAI partnership, as this partnership further endorse Microsoft leadership in the cloud and AI. The fact that they are choosing Microsoft even after when they are going public and having more order coming from Microsoft is the proof that Microsoft is the leader in the OpenAI cloud infrastructure. And we also, if you look at the chart on the left side, on the bottom left side, right, if we look at it, we believe that year-over-year increase in capital expenditure generate comparable return. So commercial cloud revenue growth is 103% of the capex increase over the past 2 years. So it's like whenever they spend capital expenditure, you see that the growth in revenue as well in the same quarters. So we think that using commercial cloud revenue is the appropriate measure, given that commercial RPO backlog is mostly accounted from the commercial order instead of the consumer. 98% of those orders coming from commercial and enterprises. And then not to mention that CapEx is primarily directed to cloud and AI infrastructure. So Microsoft CapEx, commercial cloud revenue includes Microsoft 365 commercial, Microsoft Azure and other cloud services, and the commercial portion of the different services, including AI related. Yeah. So Microsoft, and just to note that whenever they spend capital expenditure, it's not solely on AI features only. It's also have helped them cloud infrastructure business. So Microsoft CapEx primarily supports expanding cloud computing capacity, which has proven very highly rewarding to Microsoft's whole portfolio, and it's not solely on artificial intelligence play. So we also make some adjustments to our financial year 26 estimate. We raised our PPE paid in cash to 83 billion US dollar from 80 billion that we primarily estimate. So after CapEx has reached 35 billion US dollar. So all in all, our call, we will maintain accumulate call recommendation with a lower target price of 540 US dollar, down from 550 US dollar, coming from this higher capital expenditure that they spend. They haven't shown the higher earning revenue probably in the next few quarters. We still like Microsoft because it's the leader in the cloud and AI industry. This recent increase in 51% in backlog, plus with the OpenAI 250 billion US commitment, in the future prove it. And Microsoft Azure as a growth driver has done really well to uplift Microsoft group revenue. Plus, with more demand on the horizon, more upside for Microsoft by increase its supply capacity and accelerate revenue earnings. So that's all from Microsoft. Move on to the next presentation, ABNB. So for Airbnb, they released a result last week. So they released a third quarter result. So the 9 months of 2025 revenue at PATMI met our expectation at 79% and 83% of our financial year forecast. So the numbers is not exactly 75%, right? That's because Airbnb is a travel demand company, so it means like they are highly correlated to the seasonality factor, as the third quarter have higher earnings and revenue coming from the summer factor, right? So revenue rose 10% year over year, mainly driven by 5% year-over-year acceleration in the average daily rates across all regions. Looking at the positive points, first we have the sequential increase in booking volume. Booking volume rose 9% to 133 million, up 2% sequentially, driven by the strength in the US market. The growth this time was supported by longer lead times. Booking means that people book their ABNB a lot earlier, partly due to the newly introduced reserve now, pay later. So now guests can book for ABNB, but they with zero upfront payment. So this has helped drive the US market, which is their largest market, which eventually have their booking volume rose by 9%. Next is the average daily rates continue to accelerate. So this is another important metric that we are looking for ABNB. So ADR for short rose 5%, which is higher than 1% in the same quarter last year. This increase particularly was mainly supported by the Forex tailwind, which is contributing about 3% of this ADR accelerate. There's also another factor that the short-term stay continue to outpace long-term stay. Next positive point is the international expansion continued. Booking volume, next night book in the expansion markets grew at a twice rate of the core markets over the past 12 months. Expansion market is market that is outside of the North America. Core market for ABNB is the North America, which is basically United States, where they started the business from. Expansion market is basically Latin America, Middle East, those kind of countries and region. So expansion markets such as Latin America and Asia Pacific have saw about 20% and mid-teens growth in the booking volume. So there's continued to be positive points, which is in comparison, North America is only growing at 5 to 6%, which is a lot lower. And then we have negative points. This time we have a flat earnings year over year. Net income only inched 0.4% to 1.4 billion. So this time, this higher revenue was offset by investment in new growth and policy initiative because they're spending money on the new business that are coming up. That includes the $213 million valuation allowance against the deferred tax. And that's for the negative. Continue to the outlook. ABNB for the fourth quarter expect revenue to rise by 9% year over year, another single-digit growth. And for the financial full year of 2025, ABNB targets adjusted EBITDA margin of around 35%, which is a lot lower than last year. So this time it would be driven by investment in new growth and policy initiative. They're spending money again, about 200 million, as they said before, in the new services. Our view is that, for the call, we maintain our neutral recommendation with an unchanged target price of $127. We maintain a neutral call because we think that expansion markets growth, which is like Latin America and Asia Pacific, remains small to offset the growth revenue deceleration. Asia Pacific and Latin America delivered a double-digit growth in this quarter again, with Brazil, for example, one of the earliest key markets, up 20% year over year. However, group revenue is decelerating as a whole. For example, by this year, we are expecting 8%, a single digit. So this is a lot lower compared to last year, 12%. So although we are seeing the higher growth in the other regions like emerging markets, but as whole, as a group, revenue is not accelerating, it's like decelerating. So expansion market is still small to cover the group revenue deceleration. And then we also view that ABNB is pursuing more organic growth beyond its core short-term rental business. So now instead of just rent a room, they are like trying to do other business as well. They are doing ABNB services, they reinvent ABNB experience and newly launched this quarter hotel pilots. So like they are doing a lot of things. I think we think that they are targeting a double-digit growth back in the group revenue, but unfortunately we haven't seen any performance metric that indicate that this is doing well. So it's like quietly still immaterial at this point. We can't really say. But in the near term, if you're looking for growth for ABNB, it's probably the recently launched ABNB services, the 10 categories of professional services that can be booked alongside short-term rentals. But they haven't yet reported any material progress as well. There's some sort of positive feedback, so we can't really predict much coming from these figures. So we remain neutral for ABNB because of the reason that was mentioned earlier, and TP remain at $127 US. All right, this is all for ABNB. Pass over to Ben for AMD presentation.
Thanks, Fahmi. I'll present on AMD's third quarter results. Our report was published last week, rising interest from leading AI firms, which I will explain more. Yeah, so for the third quarter revenue, it's within our expectations at 70% of our full year forecast. Their PATMI exceeded our expectations at 88% of our full year forecast because of the MI350 GPUs ramp, as well as they are experiencing higher average selling prices for their EPYC CPUs. Yeah, so as you can see on the table on the left itself, their data center segment increased by 22% year on year. This is driven by strong demand for MI350 GPU from hyperscalers as well as cloud service providers. And also another positive is their EPYC CPU is also continuing to gain market share against Intel. So for AMD's data center segment, even it increased by 22% compared to Intel. Intel's data center segment declined by 1% year on year. So we do think that their server CPU is still gaining market share against Intel. And for their data center segment, even though there's an impact on the MI308 chips to China itself, they are still able to grow by 22% year on year. So I do think that this is a very respectable value. Compared to previous quarter, it increased by 14%. Yeah, so this quarter it increased by 22% year on year. So we can see the ramp in MI350 GPU. For the negatives, their gaming segment is guided to be down strong double digits sequentially for the next quarter. This is because because of the inventory cycle of Microsoft and Sony, which is their main gaming segment customer. For next quarter itself, they will slowly start to ease off the preparation for the holiday season. Yeah, but gaming segment only makes up about 10% of their total revenue. So it's not expected to be a very material impact. In terms of their guidance for the next quarter, revenue is expected to increase 25% year on year. This is driven by server CPU growth, as well as the continued MI350 GPU ramp, as well as their client PC segment is also experiencing strength, continued strength from the previous quarter, still gaining market share from Intel. Their client PC increased by 46% year on year because of record Ryzen 9000 series sales. Compared to Intel's computing segment only increased by 5% year on year. So I do believe that their client PC is also gaining market share compared to Intel. Yeah, so in terms of their adjusted gross margins, as you can see in the chart on the bottom left-hand corner, next quarter's adjusted gross margins is guided to be 54%, which is the highest in AMD's history. So this is because of driven by increasing margins as the MI350 ramps, as well as higher average selling prices from the EPYC CPUs, their server CPUs. Our outlook for AMD, we are positive because we do see increasing demand for AMD's GPU infrastructure from hyperscalers as well as sovereign nations. For example, for their MI350 chips itself, Cisco and G42 announced that they will deploy large-scale AI clusters using AMD's MI350 chips in the UAE. Yeah, so this shows increasing demand for their GPU infrastructure. And also OpenAI, they announced that they will deploy 1 gigawatt of AMD's MI450 GPU, which is the next generation GPU, in the second half of next year itself. And they will also deploy 1 gigawatt of NVIDIA's Vera Rubin GPU. So it's an equal amount of weightage to both AMD and NVIDIA. even though AMD currently only has a 10% market share in GPU space. So we do see these announcements as a very positive sign for AMD and also sort of an endorsement for their GPU infrastructure as well as software. Yeah, so we do see a higher demand for their technology going forward. For AMD, we raised our target price to $280. This is because we raised our full year PATMI by 21% because of the expected margin expansion from higher average selling prices as well as the outperformance of their third quarter PATMI. Yeah, so that's all from my end. I'll hand over the time to Helena. Thanks.
Thank you, Ben. I'll continue with Apple. So Apple, the first quarter PATMI was within our expectation, but their revenue underperformed slightly due to they having a supply constraint in their iPhone 16 and 17, certain models. So FY25 revenue and PATMI were at 98 and 100% of our FY25 forecast. So moving on to the positive point, so the best thing about Apple is still services. So services recorded its strongest growth in 6 quarters. It's also the 8th consecutive quarter of double-digit expansion. And management highlighted that this is a very organic growth. It's broad-based across all product categories and regions. Most of the category actually shows sequential acceleration, and several segments actually achieve all-time record, including the payment services. The second was they have very stronger than expected iPhone demand. So they did experience supply constraint for several of its models for iPhone 16 and 17. It's not due to a production ramp issue. It's just they just have stronger than expected demand. So we think this demand is largely fueled by the new features like the new A19 Pro chip and also the 8x telephoto camera in the iPhone 17 Pro. And for the iPhone 17 base model, because they have upgraded value proposition, because previously certain features that's exclusive to the Pro model are now made available in the base model. And for the entry-level iPhone 17, they now offer double the prior meet with the heightened demand. So another positive point is they have very, very strong positive outlook for the next quarter. They have guided a 10 to 12% year-on-year revenue growth, which is the fastest growth in 4 years. So they've never given such optimistic guidance. So the growth is projected to be driven by double-digit growth in iPhone sales. Again, very optimistic guidance. Because of their strong demand in iPhone 17 lineup. Services are expected to continue their strong momentum. And the company is significantly increasing its focus and investment in AI as well, because management now see it as a key growth lever ahead. So one negative point about it is the China market is still a miss. After a brief rebound last quarter, it slipped again down 3.6% year-on-year for this quarter. So this decline was also mainly due to a supply constraint and the later release of the iPhone 7 Air model in the China market. So management, they're still confident. They're guiding for a return to positive growth in the next quarter because they've seen heavy store traffic. So that usually signals strong demand for the iPhone. Moving on to guidance, Apple, they expect their, like I mentioned, they expect their revenue to grow 10 to 12% and iPhone to grow double digit. They've also guided a gross margin of 47 to 48%, and this is already taken into account of the tariff impact, which is 1.4 billion. So we think overall Apple has several key strengths. They have a solid financial position. They have a massive in-store user base. They're seeing strong demand for iPhone 17, which is definitely positive for the near-term outlook. However, we think it's an AI race. So their AI rollout thus far has still been disappointing. There's no game-changing AI yet, but we might see it coming out in 2026 when they roll out the new Smart Siri. But the AI scene, we really feel it's a double-edged sword because their strategy, now they're trying to collaborate with all the leading AI partners. So that kind of allows them to keep their AI investment lighter compared to their competitors, which might not be a bad thing because now everyone's talking about the AI bubble. But given the lack of clear high growth drivers and forward PE ratio is well above the industry average right now, so it does appear stretched. So we continue to remain cautious. We raised our FY26 revenue and PATMI assumption by 1% and 5% to account for the higher than expected growth in iPhone. And we increased our DCF target price to $230, and we maintain a reduced recommendation. So that's all for Apple. I'll move on to Grab. So Grab, next slide, please. Grab also released their earnings last week. So both their third quarter revenue and PAMI meet our estimate. The 9 months 25 revenue and PAMI were at 72% and 60% of our FY25 forecast. We do expect PAMI to be backloaded in the fourth quarter as the company turns more profitable. So revenue growth remains strong. It grew 22%, which is driven by both the strong performance in on-demand service and financial services. Moving on to the highlight, the positive point is their product-led strategy is driving on-demand services. So on-demand services means mobility and deliveries. So both were posting strong results, growing 70% and 22% respectively. So the company's product-led strategy is definitely gaining momentum. They're coming up with more saver options like Grab Bike, Grab Car Saver, and Saver Deliveries. So these are attracting the young, price-sensitive users. It's accounting for about 1/3 of the new MTUs. While high-value services like Grab Executive Rides and Priority Deliveries, they're also gaining traction. It includes 66% year-on-year. This is supported by the Flume customers. The Grab is also successfully trying to cross-sell and retain their users. They've lifted their GMV per MTU by 7% year-on-year, despite their MTUs already growing at a very fast rate. So the flywheel effect is also accelerated via their viral product features like group orders or family accounts. All these are providing a sustainable foundation for their continued growth. Second, it's been a while. Their financial services are expanding really well. It rose 41% year-on-year. Loan portfolio increased 65% year-on-year. They're gaining traction in their digibanks and Grab Finance. So the growth is driven by their ability to leverage on their ecosystem data to cater to the underbanked users without the traditional credit history. So around 1/3 of their borrowers actually had no prior credit history. So Grab is the one that chooses to onboard them. And surprisingly, their repayment performance has been stronger than expected because these people themselves, they also want to establish a good credit record in order to be incorporated into the entire finance industry. So on the long term, this support the financial inclusion while expanding Grab's addressable consumer base. The last point, advertising is also a long-term growth driver. Their quarterly active advertiser on Grab's self-serve ad platform grew 15% year-on-year, and average advertising spend grew 41% year-on-year. This shows very strong adoption and ROI-driven budget expansion. So ad penetration in food delivery continues to rise. And right now, because their Grab Mart is aggressively expanding, it's expanding 1.5 times faster than the entire delivery business. So Grab is set to capture the more of the fast-moving consumer good advertising spend. So this is usually an area where ad penetration is typically even higher than online food platform. So together, these trends support sustained growth and expanding advertising margin over time. Management has positioned advertising as a key long-term growth and margin driver for Grab. In terms of guidance, they've increased their revenue growth from 19% to 22% to 21% to 22%. They've also guided adjusted EBITDA growth of 57% to 60%. We think overall they deliver a pretty solid set of quarter three results, supported by substantial revenue and MPU growth. Its product-led strategy definitely is helping them drive share gains in both mobility and food delivery, particularly in Indonesia. Indonesia is their core overlapping market with their competitor GoTo Group. So GoTo Group is actually they're trying to decrease their incentive to focus more on profitability. So it's actually a good chance for Grab to try to take as much market share as possible. And data that's integrated across the multiple mobility, delivery, and subscription. But with that being said, they still have some risk because competition is still intensifying and they still have very elevated consumer incentives. So that's going to continue to weigh on margins. So in terms of valuation, we increased our F1 prospect and expanding margin for both on-demand and financial services. We also decreased our beta because Grab is turning profitable and the business volatility has calmed down. Overall, we maintain our buy recommendation and we increase our DCF target price to $7. So that's all from me. I'll pass my time to Glenn. Thanks.
Hey, thanks, Helena. Yeah, so we'll just be doing the three banks. I think I saw quite a few questions, on all the banks and the results, and so the target price. So this will be a good update for all three of the banks. And I think I will be able to answer, I think, all of your questions here as well. Yeah, so we'll start off first with UOB, since they were the first to announce, and they were also, I guess, the most spectacular results, but not for a good reason. Their earnings were way below our estimates, mainly from this higher than expected specific provisions, and also the 615 million preemptive general provisions that they set aside. So this really increased their allowances for the quarter, and resultantly our 9-month PATMI, the 9-month PATMI was only at 56% of our FY25 forecast. Just some key highlights, I won't go into much detail because it's quite a similar story, but net interest income has continued to decline from net interest margins dropping. Fees were very weak for this quarter as well. Mainly, the reason that they gave was because of higher card rewards expenses, which more than offset the growth in their loan-related wealth, and card activities. So this card rewards expenses, they were saying there's only going to be one for this quarter, mainly coming from Thailand. And I guess the key highlight was the surge in allowances. So their allowances or provisions more than 3x to 1.4 billion, really coming from, firstly, around less than half of it came from this general provisions preemptive that they set aside. So this was to I guess boost their NPA coverage to 100%. Previously, it was technically it's still lagging behind their peers. If you look at UOB and DBS, they're around 130 to 160%. Right? So even with this increase in their NPA coverage, it is still below that level of their peers. Right? So it's really just to help to boost it. And the other reason they gave was to help to prepare for valuation declines. So that was the second negative that hit them, was that they had higher specific provisions, and it came from a few of their properties that they had to sell, right? And they sold it at around a 10% lower valuation than they had accounted for. Hence, they had a higher specific provisions, and it was mainly in Greater China and in the US for their commercial real estate properties. Yeah, so they're just looking at the rest. If you look at the rest of their remaining, I would say the loan portfolio, it is quite well provisioned, quite well collateralized. For Greater China, it's around 40 odd% LTV, loan to value, and then for US it's around 70%. Yeah, so it's still quite healthy, but they are just factoring in and preparing for the worst, which is I guess quite expected for UOB, so to boost their NPA coverage. Yeah, so they have continued to the good thing about the dividends, if you're a dividend investor, and I guess most of you are, is for UOB they will exclude, or they will add back this 615 preemptive general provision into dividend calculation. So they're not going to take the net profit that you see now, which is for this quarter is 443 million. They're not going to take that to count their 50% dividend payout. So they'll be adding this 600 odd back, and then they'll calculate from there. But even if you add it back, you also realize that there is quite a big decline, right? You add it back, we're looking at about just below 1 billion for the quarter, compared to the previous years, we're looking at 1.6 billion. So it's still quite a big decline. So we are expecting that the absolute dividend per share will decline for UOB, and yeah, so that will be the case. In terms of their moving forward, they will still continue with their capital returns. I think what's left will be the share buyback. So this will continue. The 3 billion that they are looking to return back will continue until 2027. So far, they've only completed around 25%. We maintain our neutral call with a lower target price of $30.40, mainly from this higher provisions estimate below our earnings by our FY25 earnings by 18%. So we believe that their NIM compression will ease slightly in the second half, really from improvement in funding costs, because they are going to, we believe that they will, if they see margins declining too fast, they will continue to cut their deposit rate. So like their one account and their fixed deposit. But then again, this preemptive GP has really will really hit their earnings, and that's why we lower our target price. And also, if you look at the share price for UOB, it has also taken quite a huge hit. Yeah, so we do have a neutral call for UOB. Now moving on to the next counter, I guess we'll go in according to when they release their results. So the next one they released shortly after UOB's one, and in really quite a big contrast would be DBS. So DBS's earnings came in a little bit above our estimates, right? Their third quarter earnings of 3 billion came in. The 9-month earnings was around 77% of our forecast. Dividend per share for the third quarter was expected to and it came in at 75 cents. So this comprises of the 60 cents ordinary dividend and the 15 cents capital return dividend. So DBS is the easiest dividends to forecast because they just tell you how much they're going to give, and it's not based on any percentages, but it's just the absolute amount. Overall, their results, you see the net interest income is virtually flat, right? Because they benefited a lot from loans growth and deposit growth, and which helped to offset the decline in margins. Fee income was the big growth driver, or helped to at least stabilize earnings. It grew by 22%, but really from wealth management research by 31%. Allowances also declined slightly because they had more write-backs this quarter, 45 million. So this helped to offset some of the specific provisions they had. So all in, you look at the results, it was as good as stable. It only fell by 2% year on year. But I think the main highlight and the reason why we maintain accumulate, and we also increased our target price for DBS to $58 is because of their dividend policy. It is the best, I guess, amongst the best and the most predictable amongst the 3 local banks. They basically are able to give you a set amount and say that we will be increasing by how much every year. So they will previously, their capital returns, they said they will be giving they'll be doing 8 billion in total. 3 billion will be in share buybacks, which they are still continuously doing. The share buybacks wise, they have only, I think, done around 12% as of now of that 3 billion. And then they have another 5 billion, which they have set aside some of it, which is what you are getting now in the 15 cents capital return dividend. But the other, I think there's a remaining around 3 billion. They haven't confirmed what it was. So now they have given some confirmation and guidance that this remainder, this total of 5 billion will be given back in special capital return dividends. So that's very good clarity. So it means that we can safely say that they'll be giving this 60 cents per share per year until FY27. So we can expect 15 cents per quarter extra, right? Every quarter until 4th quarter of 2027. So it's almost 2 years of guidance for this ordinary dividend. And on top of that, they're also extending their ordinary step-up dividend, which is what they call it, is at 24 cents per year. So they will be starting in the 4th quarter of 2025. So we'll get another 6 cents in the 4th quarter of 2025, then 1st quarter, 2nd quarter, 3rd quarter of 2026. Yeah, so that will be then 3rd quarter 26 when this ordinary step up will end, and then they will give again, if they can do it, they will give guidance on whether or not they'll be continuing with this ordinary step up. So all in, we have an accumulate call with a higher target price of $58, really for all these reasons, that DBS has the best capital return plans. They also have the best dividend policy amongst all the 3 banks. Yeah, so that's for DBS. Now moving on to the last bank that released their results was OCBC. So OCBC's results were, in between the two. It wasn't amazing, but it wasn't that bad either, right? But there was a lot of uncertainty, and we are really not given a lot of guidance. It might be due to the change in their CEO, right? Because they're handing over, so there might be some uncertainty until he takes over. Then he can actually give a bit more guidance. But their 3rd quarter earnings were slightly above our estimates, mainly due to a surge in wealth management fees. So their 9-month earnings were at 77% of our forecast. the main highlights, being that their net interest income has continued to decline. It fell by around 9% year on year, really from the decline in margins. And the loans and deposit growth did not help to offset it, like what we see in DBS. But what's also what we have seen some similarity to DBS is that their wealth management fees have surged, which helped to offset some of this decline in the net interest income. So really, you look at it in a whole, OCBC and DBS have benefited from, or at least their earnings have benefited from this increase in wealth management activity, which is to be expected because of lower interest rates. People will tend to want to put their money to work, right? So they put it into investment products, wealth management products, which is why we have seen. Sorry, just to backtrack again, is for UOB, the reason why we have not really seen that, the reason they gave the last quarter was because their customers are all quite prudent, right? They see, the market is very volatile. Instead of putting it back into investment products, they just plug it into fixed deposit or even just leave it in their current account. So this gives very low margins and it doesn't help to grow their fees. But for OCBC, we are seeing it that their healthy growth, right, around a 34% growth in their fee income. So that helped to offset a lot of their decline in the net interest income. For OCBC, their allowances have also declined. So it was really due to a write back or GP of 1 million compared to the previous year. They had some GP accrual. Yeah. So all in, the main reason why we do maintain the neutral with a slightly higher target price of $17 is because OCBC does not give a lot of clarity or guidance on whether or not they're going to continue with their capital return plans, right? So they are just sticking with the same capital return plan they gave in end of 2024, I guess, where they said that they will be giving this until end of this year, right? And then they said, like, again, this quarter, they said, oh, we're just going to give you until the end of this year, we're maintaining this. And when we was asked, oh, are you going to continue because you have the capability to do so? There was no guidance or outlook. They said you just have to wait and see, right? So waiting and seeing is not a good position, I guess, for any investor. Which is why we maintain a neutral. Why we believe that OCBC can continue with this, firstly continue with their capital return plans and also increase their dividend payout ratio. Is currently at 50% and they're sticking to it. It's because they have the highest CET1 amongst the 3 local banks. It's around 15%. So you count based on the optimal CET1 that they're looking at of 14%. There's around 2.7 billion excess capital that they are not giving any indication of where they're going to put in, right? So we believe that with this excess capital, they are actually able to continue the special dividend, which is an additional 10% dividend payout ratio for at least 2 more years. So until FY27, like what DBS is doing. Yeah, but then again, they haven't given any guidance, which is why we are maintaining a neutral. So just to wrap it all up, since there's so many questions on the banks, we believe that the DBS is still the strongest amongst the 3 banks, really, for their very clear dividend policy, and also they are able to maintain their earnings quite well. And if the second would be OCBC, because earnings is still quite well, but they don't have that clear dividend policy guidance. And then the last one, of course, would be UOB, because their earnings have declined quite sharply from higher provisions, and they also don't really give much, I guess, as much clarity on dividends as DBS. Yeah, so that's just the ranking of the 3 local banks. So that's all for the banks. I'll now hand it over to Darren. Thank you.
Yeah, thanks, Glenn. Yeah, run through some of the REITs here. So for first REIT, their results were impacted by FX, but operationally wise, in local currency terms, everything remains stable. So it's a 5.5% increase in local currency terms in Indonesian rupiah for the Indonesian hospitals. Yeah, so revenue is purely impacted by FX, as you see the left chart. DPU is down 7.3%, also purely by FX. In the third quarter, DPU was 0.52 cents, so that's lower than 0.55 cents quarter on quarter as well. Yeah, so for the positives, in this quarter, they divested the Hotel and Country Club, so IAHCC. So if you just to recap, this hospital, Hotel and Country Club, they've been trying to sell it for the longest time. So at least the past 3 years. So it was on a single year renewal lease until they managed to sell it. So they finally managed to sell it to Lipo. And the price is sold out at is 22% over their initial purchase price and at 0.65% above valuation. So it's good that they managed to divest this, because first of all, this hotel and country club is definitely not part of like their strategy, because their strategy is mainly healthcare assets, hospitals and nursing homes. So this hotel and country club is not part of strategy. And this hotel and country club, I did a site visit back then 3 years ago. Yeah, this hotel and country club is quite dated. It's old and needs a lot of capex and maintenance. And yeah, there weren't many people there as well. So this asset was 31 years old already. So it needs a lot of like maintenance and upgrading works for it to be relevant again in my view. So it's definitely a good thing for them to sell. Yeah. So next is for them, they have stable capital management. Their gearing all remains healthy. The cost of debt declined year on year, so 20 basis point decline year on year. 20 basis point decline quarter on quarter. From the year end 2024, cost of debt was 5%. Yeah, so now 49.5% of their debt is hedged, so they will benefit from lower interest rates. Yeah, and for the negative for them is that the rentals continue to be owed by MPU. So during this quarter, MPU they paid 2.1 million. So right now, as of the end of third quarter 2025, 6 million remains outstanding. So they continue to be on this installment plan. So hopefully they will continue to make payments and eventually pay off all of their arrears. Yeah. So currently right now, First REIT, if you all know, they're undergoing a strategic review. So that is to assess the letter of intent that Siloam has to acquire all of their hospital assets in Indonesia. So they're kind of evaluating all options. So it's been quite some time, almost 9 months now, if I calculate correctly. Yeah, with no material developments. So Siloam, they have already taken up a loan, 11.5 trillion. So that if that happens to be the final price, so that will be like a 10% above valuation that they'll pay for the hospitals. So First REIT, like, you get some good valuation gain. Yeah, but that there are no material. Other than that, there are no material developments from First REIT's perspective. Yeah, so for the depreciation of Indonesian rupiah, First REIT they hedge out. Sorry, excuse me. First REIT they hedge out their Indonesian rupiah. 40% of it right now is hedged up 6 to 12 months. Yeah, so that will slightly mitigate the impact of the depreciation of Indonesian rupiah, which is down 5% year on year. Yeah, but at least First REIT inside inbuilt their Indonesian hospital portfolio, they have a 4.5% base rental escalation. So that will potentially help to offset the impact of the FX. Yep. So with that, no change to our target price and no change to our buy call as well. And First REIT currently, despite all the FX headwinds, they're trading at about 7.8% yield. Yeah, so we think that is still decently attractive, and upcoming it is likely that they will get some potential divestment gains, and yeah, that will be another plus for them as well. Yeah, next slide, please. Yeah, so for Stoneweg Europe Stapled Trust, yeah, so the results were in line with expectations. So gross revenue is up. So that's mainly because of a contribution from completed redevelopments, higher rents in the portfolio as well. And for third quarter 2025 specifically, there is a 2 million one-off income. So that really boosted the distributable income in the third quarter. But for 9 months, the year on year is down 4.6%. Third quarter is up 0.6% mainly from this 2 million one-off income, because despite the higher MPI, if you recall, they refinanced their bond. So that really really increased the all-in interest rate at the start of the year. But we think the DP going forward would have definitely will have growth potential, as all their financing is already done. Yeah, I'll talk about that in a bit. Yeah, so for the operating performance, the performance was rental reversions was strong, 7.6%. 9 months was 11.1%, and they also released 6% of the portfolio. So that is 97,000 square meters of leases in third quarter. So that is quite significant. And the occupancy also increased 110 basis points to 93.5%. So that's led by the logistics and light industrial portfolio. which rose 80 basis points. So the office portfolio rose by like 200 basis points, mainly because they divested a weaker asset, which was just 47% occupied. Yeah, and for them, for the capital management, their next refinancing, after they refinance all loans and they issued the new green bond as well as the loan that they took against the HUD support at a 31 basis point lower margin. So after all of that, right now they do not have any loans due until 2030. And we expect the interest rates to come down as well from the fact that right now only 56% of their debt is on fixed rate. Their cost of debt, the fact that only 56% of their debt is on fixed rate because they did a fixed to floating rate swap for this 300 million green bond. So as a result, the all-in the fixed rate dropped to 56%, so they can benefit from lower interest rates. And the cost of debt also continues to decline. Now it's 3.93%. Yeah, and following like 105 million euros divestment that's expected to close within the next few weeks, using those proceeds to pay off some of the debt, it's likely that their gearing will drop from the current 43.2% to 40%. Yeah, so with this 105 million euros expected to complete, they soon we have completed their 400 million divestment program that they set out to do in 2022 during the COVID and rising interest rate era, where they tried to strengthen their balance sheet to divest assets and keep gearing within the healthy range. So that is now complete now. So going forward will be more of acquisitions and growth. Yeah, so Fitch also they upgraded their rating to BBB investment grade, so that reflects their improved financial resilience. And right now they indicated that they will pivot to 70% like industrial logistics or data center. So all these three asset classes are higher yielding as compared to office. So this is just to benefit from the structural shifts such as e-commerce growth, digital infrastructure expansion, and supply chain onshoring. Yeah, and to top up that up, they have a 50 million stake in. They invested 50 million into the Ionics, which is a Stoneweg that sponsors data center development fund. So that we have a lot of upside NAV potential as the data centers get built and the valuations increase. Yeah, so no change of TP buy call. And right now Stoneweg is trading at attractive 8.7% yield. Yeah, next slide, please. Yeah, so moving on to CapitaLand investments. Yeah, so for CLI, their revenue is down 25%. That's mainly due to the deconsolidation of Class. But if we exclude that, their revenue was up 2%. So the improvement was mainly from the FRB related business is up 7%. The REIT is down 47%, but that's mainly due to the deconsolidation of Class. But if we exclude that, the REIT will have declined 12% year-on-year, mainly from strategic asset divestments. Yeah, so for the positives for them, the 9-month, the FRB continues to grow, so now it's up 7%. So this was driven by the event-driven fees under the listed funds platform, which spiked 6 million to 31 million. So that's from the transactions like CLI and CICT, which drove these event-driven fees. And their performance also was boosted by the contributions of the OCBC from March 2025. So far, 9 months, they contributed 12 million in FRB to the listed funds platform and 7 million in FRB to the private funds platform. The lodging management also continues to improve. So you see it's up 3%, mainly from more units open, 5.8 lodging units open. And the REPA is also up year to date, 2%. So overall, their FUM grew by 3 billion quarter-on-quarter to 120 billion. Yeah, and this quarter specifically, the fund management momentum, it picked up. And capital deployment also it rose. So far, 3.7 billion was raised year to date. So this comprises 2.1 billion private funds and 1.6 billion in listed funds. So this includes the CapitaLand China C-REIT, the CLCR, which opened at 20% above their IPO price. So the listed funds also deployed a lot of funds year to date. So that is 3.6 billion, 6% increase year to date, year-on-year increase, and mainly into accretive acquisitions. Yeah, so for the outlook for year-end valuations, we expect the China portfolio valuations to still face some downward pressure, as across the board there are still negative reversions and there are basically a lack of buyers as well. So all this will likely impact the China valuations, but the Singapore portfolio strength as well as India, these two countries will likely potentially mitigate some of the negative impact. So the valuation downward pressure will very highly likely be less, will not be as bad as last year. Yeah. And for balance sheet divestments, it remains very slow. Year to date, only 500 million, so 0.5 billion year to date. Yeah, it's mainly due to limited buyer demand. So for them, their priority is still to grow FRB and seek new funds. So their balance sheet also supports that. They have 6.4 billion in debt headroom before they reach 0.9 times net debt to equity. And yeah, their cost of debt also decreased to 3.9%. And all this will support capital deployment and fundraising. Yeah, so we definitely still like CLI for its robust fee income business and asset-light model. So which is very resilient. Yeah, so no change of TP. Maintain by and about 4.5% forward dividend yield. Yeah, so that's all for me. I'll hand over to Hashim. Yeah, thanks.
Thanks, Darren. I'll be presenting Paul's slides as he's away on a meeting. So in the Singapore market, construction has been soft from June, but it's starting to pick up 3% year-on-year in September. For retail, SG60 vouchers boosted retail sales. So we saw strong numbers in retail sales with September figures up 2% year-on-year. Next slide. In terms of tactical views, our focus is on the three banks since they released results at the same time last week. General trend-wise, the whole Singapore banking sector earnings was down about 5% as lower benchmark rates squeezed lending spreads. The bright spot is fee income, especially wealth management. So wealth management is perking up the bank's results partly because with lower interest rates, inflows are switching from deposits to wealth management and investment products. Like Glenn mentioned, UOB's results are a bit muted, and the reasons were already stated earlier. In terms of performance, OCBC performed the best for wealth management. They had a huge inflow of wealth management net new money amounting to about 12 billion, double of what DBS had. We think there's some capital upside. They have too much capital and they may pay back at least 2 percentage points of capital. For UOB, our preference is at the $30 level, as that's where the yields conservatively hit 6%. And for DBS, it comes down to dividend certainty. So for this week, quite a few results are being released. ST Engineering, Singtel, SETS. We also have corporate webinars hosting Prime US REIT, WeHer Holdings, and Marco Polo before the year end. Next slide. So this is just to show you the bump in sales. Supermarket sales, we are starting to see a bump. You'll probably see the impact gain by December, as this is the time people have leftover vouchers and they're looking to clear it. There is a contraction in awards by the construction sector, so growth has started to slow. We believe this is volatile, so we are not too worried. We expect a bounce because projects like T5 hasn't been awarded yet. Next slide. So just to provide a highlight of the Singapore monthly, Singapore indicators are robust. Banking liquidity is ample. Property sales is robust. Industrial production bounced, and tourism will rebound in fourth quarter because of the pushback in F1 to October. The biggest news now is the concern over the AI bubble. For us, it's hard to forecast whether the demand for AI applications will continue to be robust. But right now, we think even if there's a bubble, there is no catalyst that will burst it. Because generally, hyperscaler capex is well covered by cash flow. Interest rate cuts are coming, which will make funding into AI even easier. And Gen AI is still in its early stage. It's only been about 3 years since there's widespread adoption, and we think there's room to run. We should also expect some news on EQDP by end November, if not December. This should perk up the Singapore market. Next slide. Next slide, please. The chart on the left, the red line we see here is the combined capex of hyperscalers like Google and Oracle. So you can tag it as a proxy to total AI capex. we can see that the operating cash flow more than covers current capex levels. And the chart on the right shows that we haven't reached the blowout phase yet. Currently, valuations are a bit stretched and companies need to earn into these high valuations. But our view is that it's not time to worry about AI capex yet. So with that, we've come to an end, and I'll pass over to Fahmi. Thanks.
Yeah, maybe I'll start the ball rolling. I'll do some of the questions first. There are quite a few questions, I guess, on the Singapore banks. Yeah, first one here from Ian. Any ideas on the updated Tier 2 capital on the 3 local banks? Any big swing today? Yeah, no, they don't. They haven't really. The capital, I think you're talking about, if you're talking about CET1 wise, no, it hasn't moved. The fully phased in, it's still quite stable. I think all the banks are hovering around 50%. But their optimal ratio is around 13.5 to 14, depending on which bank you're looking at. But yeah, they still do have a lot of capital left, and they will I think DBS is really the only one that's giving it back very generously, whereas the rest are not as generous, I guess. Yeah, which is why we like DBS, which we keep saying that. Yeah, it's what's the outlook? I'll do this as well. What is the outlook for Yang Zhejiang Financial Holdings and Yang Zhejiang Maritime? Yeah, so we believe that when they do split, right, it'll be a lot easier to value each of these companies. But we don't cover them, so we can't give a call on it or a target price. Yeah, so the reason is that it'll be a lot easier to value each of the companies, and also they're not so diversified, I would say. They're not diversified, but they won't be so split. Like, one's doing a financial holding company, and then the other one is like doing maritime. They're very different. Hold on, next one. Yeah, good question here. Do you think UOB was overly conservative in upping their provisions for bad loans, hence impacting their results? Yes. So we always think that UOB is a very conservative bank, and they are, so very prudent. But I don't think they were being overly conservative. If you look at the NPA coverage ratios for the different, if you compare to the other banks, right, their NPA coverage ratios are a lot lower, right? It is below like around maybe 80 to 90% kind of coverage ratios. And it was now with this increase in 615 million of general provisions, we actually see that they're only 100% UOB. Yeah, so they're still way below the other two peers. And the reasoning that they gave is because of what they call it, because they are SME banks. So a lot of their collateral, right, and the NPAs are in collaterals like housing, or in like a lot of hard collaterals, right? So they don't really do a lot of trade as much as the other two. So that's the reason why they have to increase their provisions, and it's still lower than the other two banks. So I don't think they're overly conservative, but the hope is that maybe I forgot to add this in earlier. But the hope is that they put this in, they give a bit of hope to the investors, is that if their valuations are better than what they expect, then they would actually be able to write back some of these excess preemptive provisions, general provisions that they put on. So this 615 million is not like a hard gone, right? There's a chance that they will still be able to write back and then put it back into earnings. Yeah, and also the biggest plus point I can think of for UOB is that at least their 50% dividend payout ratio is not really affected, because they're going to add back the 600. But it will still be down. I'll say the absolute DPS will still be down year on year. Yeah, why UOB set so much provisions for losses? They're expecting SME to do badly. I don't think it's just SME, but the main thing is that they are expecting their CRE loan portfolio, which will be affected, which has been affected, and I think they are setting it aside just in case. Yeah, and they also said if rates improve, if rates decline, then valuations will improve. right? So they may not need to use any or all of these preemptive provisions that they set aside. Yeah, so we don't cover Yang Zhejiang Financial, so we can't really give a target price for it. Will GE earning contribution provide further upsides on OCBC's future earnings? Yeah, so we have seen it in this quarter, right? We are seeing that there are provisions. Sorry, yeah, not about provisions too much. The insurance arm has actually improved quite a bit, but then it's also quite volatile. Depends on what the customers are buying. But the main thing is they're saying they're trying to integrate everything. So it's not just going to be, oh, I just go to GE to buy insurance, right? They're going to link it up with their OCBC account stuff, right? So it'll be a whole sort of a group thing where it's all interconnected, right? And everything is flat. Everything will be, it's not like you have to log into, that's their dream, right? Their vision. It's not like you have to, if I go to GE, I can only go to GE for insurance. OCBC, my RM won't talk to me about it. Yeah, so it will be really a very flat where every department will talk to each other. So that's the reason, that's how they're actually working on having this one OCBC group, and also hoping that the GE earning contributions can improve. And it's more like a cross-sell. So both sides will sort of win from this. Yeah, hi Glenn, where do we know where the OCBC wealth money inflows are coming from? China or Indonesia? It's coming in very broad-based, right? There is no one country that actually has more inflows coming in, right? We never say, when it was asked oh, where do you see these inflows coming from? They say, oh, from Singapore, from Greater China, from others, so after you hear them say that, it's like, oh, okay, so actually it's coming from everywhere. Yeah, not particularly one country or region. Yeah, so we don't cover the Yang Zhejiang, we wouldn't be able to comment on this, but what's their price? Yeah, I think that's all for me. Hand it to the rest of my team. Thanks.
Yeah, thanks, Glenn. I think I can take on some questions. On AMD and their collaboration with OpenAI, any thoughts on whether they are chipping away at NVIDIA market share? Currently, I don't think so, because in terms of, if you compare their revenue growth for AMD, is about 36% year on year. And then for NVIDIA, they are still growing more rapidly than AMD. It's about 50+% year on year. So I haven't seen any signs that AMD is chipping away at NVIDIA's market share, because NVIDIA currently, their CUDA ecosystem, software ecosystem is still very strong, and it protects it's like a moat for NVIDIA. Yeah. But I think in terms of future developments, we see a lot of contracts being signed. For example, AMD with OpenAI as well as Oracle, and also from the NVIDIA side, they also sign deals with the South Korea government. They also sign deals with OpenAI, with Intel, trying to break into the PC segment. So I think this is the kind of dynamics we are seeing for these two players in the GPU space. Both are trying to chip away market share from each other. But I think overall the entire space is growing. So it will benefit both AMD and NVIDIA. Yeah, that's my thoughts. Okay, there's a question. I'll try my best to answer. Then if Glenn and Darren has any other further comments, I think y'all can add also. Singtel, what is the target price, and is it a better buy than STI components if only have funds for non-S REITs? Yeah, so firstly, Singtel, the target price is sorry, let me check. 4.86. So Paul covers Singtel, so his recent recommendation is an accumulate for Singtel. I think he's positive on Singtel because the party component, which is the telco in India, the price is still going up because of some consolidation within competitors as well as listing of IPOs. So it will flow down to the bottom line of Singtel, as well as the Australian Optus segment. The price, the ARPU is still going up. So that's why it will benefit Singtel. I think other STI components that Paul is optimistic on is firstly Keppel, because he recently released a report that has a buy recommendation on Keppel, and this is because Keppel, they are going to build a new 700 megawatt data center in Singapore, and also they are also having a new building, Keppel South Tower, if I'm not wrong, and they are also building a 13,000 kilometer Bifrost cable from Singapore to the US. So from that cable itself, they are able to collect maintenance fees. So through all these asset monetization initiatives, Paul is still positive on Keppel, because Paul thinks that Keppel has about $14 billion worth of assets to be monetized. Yeah. Then I think other STI components that we are positive on is also CDL. I think city developments. I think Darren can add on later if anything. But yeah, so for CDL, because it's trading at a price to book below average, and also because they are monetizing the South Beach Tower, I think year to date is about $1.5 billion. So for CDL, Darren is still positive. And then also among the banks itself, I think you can also consider DBS, as what Glenn has mentioned, because of the clarity in terms of the dividend policies going forward. Yeah, hope that gives some clarity. Yeah, sorry, the questions keep jumping. I think there's a question. Oh yeah, kindly comment on UMS integration bonus issue for 144 last Friday. I think regarding this 144 bonus issue, there won't be any. It won't affect their fundamentals. I think generally when companies go for a bonus issue, it's mainly to increase their liquidity. So my guess is maybe management wants to increase the liquidity of UMS shares to maybe be included in some liquidity weighted index or something. Yeah, so but I'm also not very sure. But later afternoon, I will have a call with UMS. So hopefully I can get some insights and share with you all if there's any. Yeah. What's the outlook on WeHer? Yeah, I think WeHer, in terms of the recurring income, is still the construction segment as well as the worker dorm segment, because construction, they have a very strong order book of about 600 million, and worker dorm, in fourth quarter itself, the capacity will increase by 30 to 40%. Yeah, off the top of my head, can't remember, but the capacity for worker dorm will increase for WeHer in fourth quarter. So that forms the recurring income base. And I think going forward, there's other segments which they are branching into. For example, they had a few announcements recently. They are going to the hotel space. They are also building a private school in Singapore. Yeah, but these two announcements is still in the very early stages. They haven't provided any financials. So if there's any, I will update again. Yeah, thanks. I think that's all from my end for now. I'll hand over to my other colleagues. Thanks.
Hi, thanks Ivan for the explanation. So I see some question for me. So some short question, how to tell capital expenditure out of a spend? Can give some figures or metric. Thanks. So actually, we apologize if there's a misunderstanding. Overspend here just to say that Microsoft spent higher capital expenditure in this recent quarter than what they guided in the previous quarter. Not to say that they spend too much on capital expenditure out of what they should be necessarily. So just saying that they spend more than what they guided. It's just simple misunderstanding, I guess. Next is on ABNB. Could the ABNB higher earnings be simply seasonality, especially with the upcoming holiday season? So ABNB earnings, doesn't simply come from seasonality factor, but it is a major factor that it helps explain why in different quarter we have different amount of earnings and revenue. So it's not like the other business where you saw linear kind of like amount increasing of revenue and earnings every quarter. So it's very hard to predict. Like for example, in the first quarter, ABNB would have higher earnings and revenue, and the third quarter as well, it would have higher earnings and revenue coming from holiday, like summer holiday, year-end holiday schools work like that. So it have explained why you see from our forecast that even in the recent, just what I explained, you don't see 75% from the revenue and earnings in the third quarter. So it's coming because of the seasonality. But if you're looking for growth for ABNB, they are doing a lot of things now. They are doing hotel, they're expanding their services outside of just renting room. They are giving ABNB services, right? Where when you go to ABNB to book a room, now you can book services. You can book professional photographer, you can book professional chef in your house. So they are trying to expand their business outside than just core business of just renting room. They are trying to expand their services because I think even they know that traveling is just a one-digit growth of industry. It's not really like you see tech companies, hyperscalers, which is fast growing. You don't see that in travel. So they are trying to do other stuff just to make up for that double-digit growth, right? But unfortunately, as what I mentioned earlier in the presentation, that you don't see that this new business that they are doing material at this moment is still quite small to move the revenues earning for the group. So it's still quite small. Although, for example, their emerging markets growing at 20% year-over-year, even then, their revenue groups still decelerating even to this financial year and to 8%. So it's not really, we don't see that this ABNB to growing, accelerating at the moment. So we maintain neutral on ABNB for the time moment. So next question, with so many favorable news on Oracle, is it time to accumulate? Though it is not one of the Magnificent Seven, will its price be aligned with them? So it's not one of the Magnificent Seven because they are not the biggest, I guess, but they are still, they currently have about 600 billion of market capitalization. That's half of trillion. So they are not some shady company, and there's a quite established as well, 50 years old companies in the public listing. But in the recent price declines, there are many reasons for that, right? First of all, it was because last time, recent few weeks, Oracle price surged because of this hype coming from the news that they came up with their cloud infrastructure, right, for the first time. So that pushed the market price up. But now we see that the hype is coming down, the price gradually declining as well. And there's also some concern on higher capital expenditure, but there's no clear financing routes that people are quite worried on that. And plus this recent market sentiment where many of these banks in the Wall Street give up statements that they're quite concerned of the stretch valuation from the tech sector. So I would say that many of this is coming from the sentiment play, like when it comes to Oracle share price. But then again, we remain positive on Oracle. We don't see that the fundamental is changing. We are looking for the next quarter, how it's going to do. And we are still positive on Oracle because of the reason that we mentioned in our initiation. It's a niche cloud infrastructure provider. We have many hyperscaler providers, but they are specifically for Oracle, they could provide for the highly regulated industry, highly regulated regions, which many of the hyperscaler cannot provide. That's one of the reasons of why their backlog increased so much, right? They have multiple partnerships with the many hyperscalers that helps them in their supply bottlenecks. And they also do a lot of stuff, which is AI training, AI inference, which is like, they are like one complete set of package that they could provide multiple services to multiple industry. And our last, why we like Oracle still because of their high backlog, which is 8 times of their financial revenue last year. So if they could convert this faster in this backlog into revenue, they could accelerate their earnings further, right? So we like that because for Oracle. So we remain positive on Oracle. We have we have buy call on Oracle at the moment, especially with the price coming down. And last question for me, I think, is this, amongst the software companies that you shared previously, which are the top that you would convince to put in your fund? So at the moment for the SaaS company, we have 2 companies that we are quite positive on. First is Microsoft and Oracle. The second is Oracle. For Microsoft, as presented, Microsoft is quite clear, right? It has a playbook that is quite clear. That we like Microsoft because of its cloud businesses, right? It's one of the largest, it's one of the leader in the cloud and AI industry. Its cloud services business segment has served the group revenue well. It has accelerated the group's revenue that you see for the last few quarters, for the last few years, it has been doing well. And even now in the recent quarters, even after a few years and quite large at that, Microsoft Azure revenue continue to accelerate further, right? From 40% year over year this quarter, from 37, from higher than the guidance and higher than the 33% year over year from the same quarter last year. And they have many other positive points. Even the new partnership with the OpenAI continue to further strengthen their relationship, and they receive quite a lot from that as well. Well, they now have a higher Microsoft Azure commitment of 250 billion, which is more than half of what their backlog they have right now, coming from OpenAI. So this would be included in their backlog in the next few quarters coming on. So that's going to benefit them positively. And for Oracle, from the reasons that I just mentioned earlier from the previous question, we're also positive on Oracle because of those reasons. Next question is, OpenAI has formed numerous partnerships since its inception, and one of them is AWS. From your research, what is your view on Microsoft and OpenAI partnership? Would it be a lasting one? As previously explained in the presentation, we are positive on this news for Microsoft. Whether this would be a lasting relationship, well, who knows who's going to last, but from what we see right now, from what we have, we think that you don't see that the tension from Microsoft and OpenAI has already subsided, that Microsoft has agreed as their largest shareholder, and one of their largest shareholder has agreed for OpenAI to go public. So the tension between them, I think, has already subsided at the moment. Well, the reason of why OpenAI partner with many of the other hyperscalers, for example, AWS, their issue is because of they lack the computing power. We continue to see significant usage for OpenAI, right? More people using OpenAI, more enterprises using OpenAI, but they don't have the cloud computing capacity. And I think their CEO for OpenAI has already said out loud before that Microsoft alone couldn't provide the computing power for OpenAI. So that's one of the reasons of why they partner with the AWS. But this doesn't mean that it's bad for Microsoft, because coming from this updated partnership, Microsoft alone has gained 250 billion committed Azure commitment from OpenAI in the future, right? Even if they lose the right to first refusal, means that if OpenAI want more computing power, they have to go to Microsoft first. Although they have lost that right, still they earn quite a lot of commitment for Azure in the future. And they also have extended the intellectual property to 2032 from 2030. So it's still positive for Microsoft from this OpenAI forming relationship with the other hyperscalers from our point of view. Yeah, I think that's all for me. Pass over to the next, my colleague to answer the next question.
Thank you. I'll take the question real quick. What is the latest on Grab? Was Gojek GoTo in Indonesia? And what other acquisitions are in Grab's pipeline? So I assume you're asking about the competition between Grab and Gojek. Because right now these two companies, they're kind of adopting two very different strategy. So Gojek is now focusing more on profitability. So they're cutting quite a lot on their incentives. So this actually opened up room for Grab to pick up the share. So it's a good position for Grab. Grab, on the other hand, they're still having very intensive incentive, but they're trying to focus more on product improvement, like I mentioned earlier. So they're trying to come up with different price tier product, like the saver delivery, the Grab bike, the cheaper option to cater to people who are more price sensitive. They're also coming up with the more like Grab executive that's catering to the more affluent people. So they're actually gaining market share on both mobilities and food delivery because of the difference in the strategy. And in terms of financial services, Grab is also in a better position because Grab, unlike GoTo, they actually do have a digibank license. So that kind of sets them apart already. And also Grab, they have a better cross ecosystem data. So that kind of gives them a higher power for credit underwriting visibility. So that helps them a lot. While GoTo Financial, they still relies more on third-party distribution and lower frequency GMV channels. That's what sets them apart. And in case of recent acquisition, they have publicly communicated that large-scale M&A is unlikely in the near term because they're trying to focus more on sustained profitability and their free cash flow discipline. So I hope that answers your question. I'll pass my time to my colleagues. Thank you.
Okay, let me take on some. Yeah, the biggest question here is if the rumored merger of CLI and MapleTree materialize, is it positive for other company? Which one stands to gain more? Yeah, so this is a very difficult question to answer because first of all, it's still speculated, and if you ask me if they have a merger, right, of course the ending entity will be a beast, will be super huge, will have like 200 billion in FUM. Because now currently CLI is about 120 billion FUM. MapleTree is about 80 billion. So if we combine that, it will be 200 over billion. So definitely when they do that, there will be a lot of synergies like between the REITs and on top of that, the REITs also currently they are sponsors to many REITs, and there is an overlap also. So it might be possible that if they combine, they might start looking to consolidate or combine some of their S-REITs. For instance, those with similar mandate, like maybe MapleTree Industrial combined with CapitaLand Ascenders or something like that. So yeah, so there are a lot of synergies, but in the near term, short term to near term, is going to be very complicated and is very complex because of the fact that it's such a huge transaction, such a huge deal, and they are both sponsors to the REITs as well. So the execution of the deal will likely be key, but it's very complicated deal also. Yeah, so which stands to gain more? I think yeah, both will benefit as well, but MapleTree currently is not listed, so yeah, it's private. But for CapitaLand, CapitaLand will likely benefit because they have this 200 billion FM target, and if they do this merger or acquisition per se, that will definitely bring them up to 200 billion straight away, because right now they are at 120 and plus this 80 plus billion that MapleTree has, they'll bring them to their target. Yeah, and definitely with size also, they can do a lot more in on the global scale as well. Yeah, so definitely if they merge, is like they will have a lot of synergistic benefits, as well as possibly value unlocking in the current years. But CapitaLand currently per se on their own, they do not have much pipeline for the REITs because they are trying to shrink their balance sheet. So with MapleTree, with the merger, they're likely to have some more pipeline to some of their REITs as well. So yeah, all in all, I would say if they do merge, it will take some time because of the complexity of the deal, and yeah, likely both will benefit. Yeah, but then again, this if it does happen, it's very early stages and will definitely take some time because it's a very complicated deal. Yeah, I think that's all I have to comment for that merger. I think there are a few questions on that. Yeah, why did CLI deconsolidate Class? Yeah, that's because back then, remember, they part down their stake to 24%. They did a distribution in specie. So now they own 24%. So with the reduced stake, they do not consolidate it as a subsidiary anymore. They equity account for it. So as a result, they deconsolidated Class. So that the effective date was 2024 year end. Yeah, so that's the reason why they deconsolidated Class, because they part down their stake. Latest update on Manulife VS REIT. Yeah, so Manulife VS REIT, their results, they're basically their third quarter results. Basically occupancy still remain very weak, 68%. There are some leases executed. Yeah, but even if it's at market, also because the market that they are in, the rents have already fallen so much. So even if it's at market, and even if the tenant incentives are below market, the rents are also very low, and it's basically they still had a negative 11.3% negative rent reversion for third quarter. Year to date, 9 months is negative 10.4 reversions. Yeah, so it's this just shows basically the weakness in the geographies or in the locations that are in. Like for instance, the Figueroa, like downtown LA, yeah, the market is performing very weak. So this is very different with the other assets that the other two listed peers have, Core and Prime. Yeah, so Core and Prime, their assets are better located. And as a result, we see they have some strong leasing activity and rents were renewed at a positive rent reversion. So it's very different for the markets in the US. Some markets are LA performing poorer than others. And the western side of US, like Texas, all these, they're performing quite well. So specifically on Manulife right now, they still have to pay down the debt. So their debt is still their leverage is still at 56.2%. So they still have some way to go. They still have to divest at least another asset to bring down their gearing as well. Yeah, so that is what they have to do. But for Manulife, the distribution is very unlikely within the next few quarters or few halves. Yeah, but for Core and Prime already indicated they will increase their DPU to 50% from the second half of this year. Core, very likely they'll increase their DPU starting next year. So it'll be a gradual increase. It won't be a one-shot increase for Core. Prime also likely, when they said they increase to 50%, they'll likely remain around this 50% level for some time as well. It'll take some time before it eventually goes back towards the 90%, 100%. Then we have to see some strong, solid recovery before that actually happens. But right now, at least the leases are signed, even though they have some like free rents and such, like a 1 year free rent for 1 month free rent for every year of lease. So a lot of the rents that they recently signed have, like when they sign long leases, like basically 10-year lease, that means it's almost 10 months of free rent. So basically the rents will not contribute yet. So because they already signed all these leases, there is income visibility coming for these leases that have yet to contribute. So as these contribute, that's why they have the confidence to slowly start increasing their dividends over time. Yeah, I hope that answers that. Yeah, can comment on SIA. Thanks. Yeah, so Miao has left. So Miao is was our SIA airlines analyst. So since she's left, then we are doing a hand takeover. So yeah, give us some time. When the new analyst is ready, we will give some updates on SIA. Yeah, what's your view on the merger? Maple Street, yeah, I did give some comments there. CLI price is not really moving much, hence TP 3.65 seems off path. Yeah, so we did our valuation. We think 3.65 is very reasonable. And because we valued the fund management business at 16 times, so we think that is very fair. So we think that 3.65 is also a 1 year time horizon. So we think with lower interest rates that will start to boost the FPM growth and transaction activity. We think we have a TP of 3.65. We think that is possible for a 1 year target. Please comment on the future dividend yield upside for next 12 months for the following REITs: Prime, Capital, Pacific, Dawa. Yeah, so for Prime and Capital Pacific, I already gave some comments. The upside for the next 12 months for Capital Pacific is like infinity, because Capital Pacific is not paying dividends, and then if they pay like at least some dividends next quarter or within the next 12 months, definitely is from 0 to, even if they pay 20%, 30% is also a lot of growth there. For Prime, currently they're paying 10% payout ratio. So if you bring it to 50% and assuming the operating performance increase, so that would be like at least a 5 times jump as well. So for Prime and Capital Pacific, there is some future dividend yield upside potential. For iREIT, specifically, they are facing their Berlin campus redevelopment. So that one, slightly that DPU will still be affected. And for Daiwa, yeah, they're currently trading at about 7%, 8% yield. So yeah, Daiwa, I need their results will be in a few days' time. So yeah, I'll give some updates after their third quarter results. Do you know why CLI cut down their stake of Class? Yeah, so CLI previously they own like 28%. Their intention, they've already mentioned that they want to bring their stake down for the listed REITs to around 20% for all their stakes. Like they want to bring down their balance sheet stake in the asset and kind of convert all of these balance sheet stake into fee FR pure fee related business FRB. So that is why they are kind of reducing their stake over time. Yeah, glucose and CDR, which has more upside potential. Yeah, so we don't cover glucose, so we can't really comment. But generally, property sales for both glucose and they have some projects that sold very well. CDL similarly. Just slip the top of my head, what was a CDL recent project? Yeah, so that one also is sold. Yeah, Zion Grand is sold 84% at launch. So that is also performing very well. So similarly to Gold Coast projects as well. Yeah, so currently the market for property is quite hot. And despite the foreigner ABSD 60%, the locals are the ones that are actually buying up all these demand, locals and PRs. Yeah, so CDL, so I'll give you a second. Let me check my target price. I can't remember off the top of my head. I think it's 8. Yeah, that basically is still we are buy call and we still have we believe there's still some upside there. Yeah, $8.34. That's my target price for CDL. Okay, let me try to answer this. Can't understand really. Some of the IPO received good overwhelming response, and yet their opening price didn't meet expectations. Some even push the price down below the asking IPO price. Actually, who are the selling below this price? Are they even selling at a loss below IPO price? Yeah. So first of all, those who are able to sell most of the time, they are those retail investors or those who subscribe to the IPO tranche. So those pre-IPO holders, usually they have a lockup period. They will not be able to sell their shares immediately on like the first trading. They usually trade, the lockup period can range from like a few months. Yeah, usually a few weeks to a few months for the lockup period. Yeah, so most of the time it's those who subscribe at the IPO itself who are the ones who are selling below who are selling the shares at open. Yeah, so regarding why some of the share prices are down, yeah, this one I think it's more of company dependent. So if let's say that it possibly is down to valuations as well. Yeah, so it's really quite hard to answer the question though. Yeah, but who are the sellers? Yeah, most of the time is those who are who subscribe for the IPO itself and not the pre-existing shareholders or those who involved in the placement tranche, as they most of the time they have a lockup period. Are they from their very own IPO company or internal people or institutional guys? Yeah, so yeah, answer that. My guess is those sellers were from that very own IPO company rather than institution. Yeah. Yeah, so it has to be a split right, between those who are pre-IPO shareholders, so those have lockup period, and those who actually subscribe for that placement or the IPO tranche. Yeah. Yeah, so that's what I view. Yeah, I think I hand over to some of my colleagues to answer some questions first if they can. Yep, thanks.
Yeah, thanks, Darren. I can try to answer some questions. With the so-called circular financing among the big caps and cross-investing within the AI sector, will this become bubble burst if the music stops? Yeah, I think when you talk about the circular financing, you're referring to recent deals among like Nvidia, OpenAI, Oracle. Yeah, I feel that if you just look at the deal between Nvidia and OpenAI, it feels quite artificial, the demand, because Nvidia will invest in OpenAI for OpenAI to buy their chips. So I feel that that particular deal itself is quite artificial. But if you talk in terms of if you want to see in terms of organic demand for AI, that will be from the hyperscalers capex to buy up GPU infrastructure so that they can support and meet their demand for the increasing AI needs within their cloud services. So hyperscalers, in terms of their revenue growth, is still ramping. In terms of their cloud segment, revenue is still ramping. And also right now, Nvidia is also facing quite a lot of organic demand from sovereign nations. So in terms of signing the deal with South Korea government, in the UAE, they are building out the Stargate project. In Europe itself, European Union budgeted about 20 billion to build up 4 AI gigafactories. So right now, I still don't see the bubble getting really big right now. I feel that there's still a lot of organic demand for AI from hyperscalers as well as sovereign nations. I think the next stage will be physical AI, but I think we are still in the early stage of physical AI, whereby, for example, SK Hynix, they set up a factory in Houston for robots to be working in the warehouses itself. Yeah, so maybe that will be the next stage to look out for. But right now, I'm still seeing quite a lot of organic demand, and the bubble hasn't really get to that stage where it will burst. Yeah, hopefully that gives some insights. Thanks. Yeah, I think there's a question about Collywood and Centurion accommodation REIT similarities. Yeah, sorry, I can't really comment much on Collywood because I don't cover LHN. And sorry, because Paul is on a meeting right now. So I think if you have any questions on Collywood IPO, you can type your questions in the Poem Tree community for him to pick up. For Centurion accommodation REIT, I can give a bit of comment. So I think why Centurion accommodation REIT has been doing well post IPO, right? It's because Centurion spin off their biggest assets into the REIT itself. So I think almost all their purpose-built dormitory, which consists of about 10,000+ worker accommodations, are being spun off into the REIT itself. So this is Centurion's most quality assets, and they spun it off into the REIT itself. Yeah, so that's why Centurion accommodation REIT, fundamentally they are doing very, very well. They also have assets from the UK PBSA and a bit of assets from the Australia PBSA being spun off into the REIT. Yeah, so that's why the Centurion accommodation REIT is doing well. Yeah. Hopefully, yeah, I think if you have any questions on Collywood, you can just type in the Poem Tree community. Thanks. I think that's all from my end. Yeah, there's a question on Sembcorp. Yeah, similarly, because Paul covers Sembcorp, so if you have any questions, you can type it in the Poem Tree and he can pick it up from there. Yeah, thanks.
Also to add to Ben's question on the circular financing coming from these OpenAI and the other partnership companies, right? Especially for Microsoft, because I cover Microsoft. Although recently OpenAI announced $250 billion of Microsoft Azure cloud services commitment from Microsoft, which sounds quite artificial as well, like Ben said, because Microsoft is the owner of OpenAI with 27% of stake, but at the same time, OpenAI is ordering cloud computing capacity from Microsoft, it sounds quite artificial. But at the same time, just remind that the Microsoft order is driven by organic order as well, demand, because currently their booking order RPO is about 392 billion US dollar, and that is like more or 1 times of the revenue last year. And this order is not only coming from, this already excluded the 250 billion US dollar commitment from OpenAI. So this 392 billion US dollar is coming from the enterprises, from the bank, from the other smaller enterprises, institution. We see when they mentioned previously, there's institution like the government institution using Microsoft Copilot, right? Their artificial intelligence and cloud services main applications. There's also bank like Barclays and all that uplift, that increase their seats from previously 15,000 to 100,000 in the previous quarter. Like more and more people using Copilot. So it's like these orders are coming from institution, from the enterprises, are not solely coming from these OpenAI alone. So we see organic demand coming for Microsoft Cloud services, so not only from OpenAI. So hope that helps the question regarding the financing and AI bubble that Ben answered there. All right, I think that's all for me. Just want to add that.
Yeah, thanks, Fahmi. So let me add on to what Ben or Ipan said about the Collywood and Centurion accommodation REIT, the differences and similarities. Yeah, so I mean, first of all, the asset class is not really similar, even though both are so-called accommodation type. So Collywood is more co-living in Singapore. Centurion accommodation REIT has that PBWA as well, the purpose-built workers accommodation that Collywood does not have, and it's also focused on the PBSA, PBWA assets in Singapore, UK, and Australia. So the asset itself is different. So Collywood is also structured. It's not structured like a REIT compared to of course the central accommodation REIT. So central accommodation REIT you can expect to be more income driven focus, while Collywood is likely more growth focused as well. Yeah, so I think that's all I have to add. Let me see if there are any other questions. Yeah, the rest of questions, I don't think we can answer. If you have any questions that we have not answered, or any burning questions, please feel free to just type it in the Q&A. I mean, not Q&A, in the P3, or you can scan the QR code that is showing on the slide now. So with that, thanks so much for joining us again. Brings us to the end of our briefing. Hope to see you again next week, and enjoy our weekend. If you're free, please feel free to join us for any upcoming webinars with the corporate insights listed companies that we've mentioned earlier as well. Okay, thank you. Bye-bye.